Hey, what's going on? Welcome back to another episode of Lunch with Lattice. I'm your host, Lattice. So today, we're enjoying a little Nella's Pizza from downtown Reading. Good stuff. And their pizza is really good. I just had a terrible workout this morning, so I feel really guilty eating pizza today. So our lunch is similar to that of a rabbit's. Anyways, today, I want to talk about PMI. What is PMI? Does everyone need to pay for it? Why is it required? PMI stands for Private Mortgage Insurance. All right? Now, a lender doesn't require everyone to pay PMI. But let's say you're putting down less than the conventional 20% for the down payment of your property. Then a bank's going to look at this and be like, this is a riskier investment for us, thus making the borrower take out PMI. So what does it do? PMI protects your bank in the case that you default on your mortgage and your home goes into foreclosure. So in order for your bank to be protected and lend you X amount for the purchase of your home without you putting down 20%, they require you to pay an insurance premium to protect them. Right? Right. So how do you get rid of PMI? Well, it's simple actually. Once you have 20% equity in your home, you can refinance, you can call your bank and say, hey, I have 20% equity, I want to take off my PMI. But that's not the only way. So let's say you buy a property, it's worth $500,000. So 20% is a $100,000 down payment. A lot of people don't have $100,000 laying around. So you take out a mortgage, say 10% down. So you put down $50,000. You're going to be paying PMI until you have $100,000 in equity. But let's say you can get that $500,000 house for $400,000. Let's say you have a great real estate agent like your boy John. I negotiate the deal, so the house is worth $500,000, but you can buy it for $400,000. You put down, we'll say 5%. So you put down $20,000. Now, right after that, as soon as possible, sometimes there is a waiting period, you go to another bank and you say, hey, look, this house is worth $500,000. I have 20% equity in it. I want to refinance. Now you're refinancing with another bank, and since the property is actually worth $500,000, you do not have to pay PMI. Pretty clever, right? Right. Now, another way to avoid it is shop around. So some lenders do have programs where you can put down 15%, you don't need to pay PMI. Now, not everyone gets these types of mortgages, but they are out there. All right? So, 1, you can negotiate a great deal. 2, you can find a lender who doesn't have PMI for 15%. Or 3, probably the simplest one, is make additional monthly payments towards your principal. So let's say your mortgage payment is $2,000 a month. You pay $2,200 a month, and you have that $200 go to your principal pay down. This is going to get you to your 20% equity much faster than just making your typical monthly mortgage payments. So PMI, it's very common. I had to pay for it on my first property. I did 3.5% down. And it's not for everyone, all right? But it can help a lot of people get into a property. It can help you get your first house, get your first condo, get your first investment property. Because if you're buying a $500,000 house and you don't have $100,000 laying around, you put down 5%, $25,000. All right? So that is PMI. If you have any other questions, let me know. Nella's Pizza. We're eating salad today, unfortunately. We'll see you next week. Thank you.